Distributing profit at the end of a financial year is the final step of a multi-stage accounting process. Before the final cut is made, the partnership must first resolve every internal expense owed to the individual partners. To find the true divisible profit, the actual cash available to distribute, we have to subtract the cost of doing business with the partners themselves. That means pinpointing the exact interest on capital and standardizing their salaries. We are going to map out the exact sequence for these deductions. We will start with baseline interest formulas, then move to the math for mid-year capital injections and withdrawals. From there, we will solve a forced equalization scenario and finish by decoding the various frequencies of partner salaries. Accuracy here is a prerequisite for a stable partnership. A single miscalculated month of interest or a misread salary term creates a cascade of errors that can mathematically ruin the partnership ledger. Interest on capital is strictly tied to time. This horizontal timeline represents a standard 12-month financial year, running from April 1st to March 31st. In a steady scenario, a partner invests $500,000 at the start of the year. If the agreed interest rate is 10%, the firm owes them exactly $50,000 for a full 12 months of use. However, capital balances often fluctuate. If that same partner injects an additional $500,000 exactly 6 months into the year, the timeline fractures. We must now calculate the interest in two distinct stages. For the first 6 months, the firm only had access to the original $500,000. We multiply $500,000 by 10% and then apply a time fraction of 6/12. This yields $25,000 in interest for the first half of the year. For the final 6 months, the active capital increases to $1 million. Applying the same 10% rate and the 6/12 fraction to this new balance generates $50,000. Combined, the partner earns a total of $75,000. This demonstrates the core principle. Interest is only earned on the specific amount of capital active in the business at a specific moment in time. We must also account for the opposite scenario, a partner withdrawing active funds from the firm before the year concludes. This timeline tracks a capital withdrawal. A partner begins with $500,000, but 9 months into the year, they remove $200,000 from the business. We calculate the interest for those first 9 months using the original investment. $500,000 at 10% multiplied by a 9/12 time fraction yields $37,500. For the final 3 months, the firm only holds a balance of $300,000. Multiplying this remaining amount by 10% for the 3/12 time fraction results in just $7,500 in interest. The total interest for the year drops to $45,000. Because the firm no longer has use of the withdrawn cash, the partner effectively stops earning on that portion of their investment immediately. Let's apply these rules to a multi-partner scenario. Partner A starts the year with $480,000, while Partner B starts with $540,000. Exactly 6 months in, the partners decide to equalize. They mandate that they must each have exactly $500,000 in capital for the remainder of the year. To hit the target line, Partner A must inject an additional $20,000, while Partner B must withdraw $40,000. Partner A's interest is the sum of two 6-month blocks. The first block at $480,000 earns $24,000, and the second block at the new $500,000 balance earns $25,000, totaling $49,000. Partner B followed a different path. Their initial 6 months at $540,000 earned $27,000, while their final 6 months at $500,000 earned $25,000. Their total interest is $52,000. Even though both partners finished the year with identical capital, the chronological path they took to get there resulted in different payouts. Time is just as important as the dollar amount. Beyond interest, we must also process partner salaries. These terms are often expressed in different frequencies that must be standardized. This table provides the necessary annual multipliers. For a monthly salary, multiply by 12. For a quarterly salary, multiply by 4. Do not multiply by 3. We are counting the 4 distinct quarters that occur in a 12-month year. A half-yearly salary requires a multiplier of 2. If the term is already listed as per annum or PA, you use the figure exactly as written. For example, a salary of $2,000 per month converts into a $24,000 annual deduction for the business. Every piece of partner compensation must be converted into a strict annual figure before you can accurately allocate the remaining profit. Now that we have calculated the specific costs for interest and salaries, we can solve for the divisible profit. As we plug our findings into the profit and loss appropriation account, the document populates with our precise interest and salary figures. These deductions are subtracted from the net profit, leaving us with the final amount available for distribution. Apply this time-weighted approach to every partner's capital account in your own ledgers. Once these expenses are resolved, the next step is calculating firm income through interest on drawings. Professional accounting requires a precise chronological map of every capital shift. By tracking the exact duration of each investment, you ensure that the final division of profit is mathematically accurate and fair to every partner.